Art Collins with you again. Got another system, a day trading system, this time off 30-minute bars. And we'll be using three indicators. I've lectured frequently on combining small biases to get holes greater than the sum of the parts. This is an example of that. Here's the rules. Set your charts to 30-minute, day session only, 8:30 a.m. to 3:15 p.m. Central Time. And again, we're going to look at three indicators and combine them. Going back to my blackjack card counting days, each indicator is going to be assigned a +1 value for a bullish reading and a -1 for a bearish reading. Okay, first one is the current 30-minute close above the 8:30 daily opening price? Give it a +1 if so, or below it, -1. Okay, another thing I've lectured on frequently, the power of having a long bias when you're above the daily 8:30 opening price and having a short bias when you're below it. So this is one of those indicators. Second one is comparison of the 3-bar average to the 10-bar average. 3-bar average higher than the 10-bar average is a +1. 3-bar under 10-bar is a -1. That's consistent to how moving averages generally work. The smaller number is the one to react more quickly. Gets the momentum first. And then finally, in the last 3 bars, were more of the closes, at least 2 out of 3, in the top half of their respective daily ranges, give that a +1, or were they in the bottom half of the ranges, -1. So, that's how we construct the indicators, and we implement them as follows. From 9 o'clock Central Time, if the sum of the 3 indicators is +3, all of them are green, then you buy the next bar at market. If the sum of the 3 indicators is -3, we sell them short at the market. Sell short at the market. Exit your long if the combined reading goes to -1 or less. Okay? So you have to enter a trade when you get a unanimous reading on the 3 indicators, but as soon as the net result is on the opposite side of 0, if you're long, 2 out of 3 of them go against you, that's time to get out. 2 out of 3 or 3 out of 3, obviously. 3 out of 3 would probably be a flip reverse. All right, exit short if the combined reading is +1 or more. Exit on the 3:15-day close. So what we have here is a bar that matches all 3 conditions. It's above the daily open. The last 3 closes, 2 out of 3 of them, in this case 3 out of 3 of them, were in the top half of the ranges. And the purple is the 3-bar average close. Yellow is the 10-bar, so that condition is also met. 3 bars ahead of the 10-bar. So we buy, and then about here we see that 2 out of the last 3 closes are in the bottom half of the range. Again, in this case, all 3. The 3-bar close for the first time in several bars. 3-bar close goes under the 10-bar. So we have 2 out of 3 conditions that are bearish. So we just flat and exit the long here. Okay, life goes on here. And then on this bar, we're again getting a unanimous short side signal. We're below the daily open. At least 2 out of the 3 bars closed in the bottom half of their ranges. This one didn't, but these 2 did. And the 3 bar close is under the 10 bar close. So in this case, nothing changes and we exit on the close. And from the start of 2010 through June 18th, 2020, we get $97,000 on 4,169 trades, $23 average before slippage commission. Just under 42% of your trades are winners. Drawdown, a little steep. I'd suggest tooling it in your own lab. $14,000, but you divide the $97,000 by that, and you get 656%. The percentage of your account would have increased had you started with your worst drawdown amount. And as always, I demand, and in order for me to show it to you, get corroboration in the other markets. S&P remains your best bet. Dow is a little better than break even, but the other three, more than double your money over the 10 years, more than triple it. All right, so that's that. Until next time.